Okay, good morning. Today we're going to move on to chapter 3. And these are more basics in accounting. Okay? And what we're going to talk about a lot here is the general journal and the general ledger, which is basically your diary of all the transactions that you do in your business. Okay? And we're also going to talk a little bit about the trial balance. Okay? So, our learning objectives is journalizing, analyzing and recording business transactions into a journal. Think of it as a diary. That's the best way to look at it. Posting, transferring information from the journal to the ledger. The ledger, as we're going to talk about, is just a list of all the accounts you have. Cash, accounts receivable, accounts payable, revenues and expenses. And they're by accounts. So cash is going to have their own ledger. And it's going to tell you about all the cash transactions that you did, all the money you collected, all the money you spent on expenses. And then we're going to talk about preparing a trial balance, which is really important because the trial balance is your check. It's your check to make sure that it's right. So, journals, normal procedures occurring over a period of time. Now, usually this is monthly. We highly encourage to do this monthly because you want to know. You want to know what your assets are worth. You want to know what you owe. You also want to know what the worth of the company is. You also want to know all the revenues that you've collected in the month and all the expenses that you've paid off. And then, of course, you want to know the bottom line. What was your net income? What did you get to keep? Okay? And it takes place over the accounting period. Now, the accounting period is usually 1 year, and that's the way the IRS defines it. But normally in a business, we're doing this monthly, every month. Okay? One of the most disturbing things to do when you go into a company and do consulting is find out they haven't done their accounting for 3 or 4 months. If you haven't done this, you don't know how you're doing. And it's usually wrong, and they think because they have money in the bank that they're doing okay. And that is not always true. Okay? We can do it yearly 2 ways. Calendar year, of course, which is January 1st to December 31st, or we can do it fiscally. And a lot of companies do it fiscally, and that's any 12 consecutive months. Okay? And it can be anything. A lot of places I work, they went June to May. Some of them went August to July. Okay. The accounting period is a period of time covered by the income statement. Can be monthly, quarterly, and annually. We want to start out monthly. Okay, so we know where we're at. Are we making money? That's super important because, of course, you have to make money to keep the doors open. Quarterly, if you're publicly traded on the stock market, commodities market, anything like that, you must post your quarterly financial statements online. That is the rule. Or you can do it annually. And they also have to post their annual financial statements online. That's basically because anybody wants to buy stock and invest in the company. They should be able to go to your website and see all this and make a conscious decision on whether to do that or not. Okay? And this is called a natural business year. Usually at the slowest time of the year. That is why you see some people go fiscally, because in January, there is a lot to do. You're closing out the books. You're coming up with W-2s. People are making changes. There's just all kinds of stuff going on. So it may be better for you to go August to July so you're not putting all the burden on accounting all in January. We know that monthly and quarterly reports, of course, are interim reports. The final one, the annual, is usually your final one. Now, general journal is your book of original entry. And it's like I said, it's a diary of all your transactions. Simplest form of a journal, okay? Whatever transaction you do, you write it down or you put it into the computer. All transactions are located in the same place. It has to be transparent. and it has to be able to be explainable. Okay? Records information in chronological order. Okay? So we start January 1st. If we're on a calendar year, we go all the way to December 31st. Okay? Information is then transferred to the ledger by account. Remember, the ledger is by account. Here's a great example of a chart of accounts. And if you're computerized, which I highly recommend you become computerized if you're not, it just gives this to you. Now, you can add specific accounts if you need to. That is very common. Okay, you can see the assets are 100s, the liabilities are 200s, owner's equity is 300, revenue is 400, and expenses are 500. And this is the way it's been set up for years and years and years. Okay. The debit portion of the transaction is always recorded first. We're always going to do the debit first. Why? Because it is what it is. That's the best rule to follow. Okay? The credit portion of the transaction is indented and placed below the debit portion. The reason why it's indented is because it makes it easier to read. Okay? Because if the IRS or any auditor can't read it, they're going to disallow it. Okay? And that can cost you money and fines, interest, all kinds of things. The explanation of the entry follows the credit. Always put an explanation, because in 6 months, you're not going to remember what that post was, what that transaction was. Because if you're a bookkeeper, it can be very common for you to enter hundreds of transactions a day. Okay? A one-line space follows each journal entry to make it easier to read, because remember, we want total transparency. We don't want anybody coming in and saying, wow, they're up to something. We don't want that. Okay? The total amount of debits must always equal the total amount of credits. Okay? Always. If it doesn't, it won't balance. And that means you boo-booed somewhere. You're going to have to go back and look to see what you did. Each transaction may affect at least 2 different accounts. Always. Always. Okay? Here are some examples. Brenda Clark began the business by investing $10,000 in cash. These types of questions are story problems, as we discussed in the first video when we were talking about chapter 2. And we look for key words. The key word here is investing. Okay? Anytime we see the word investing, automatically we think of owner's equity. The owner of the company is investing her own money into the business. So, this is a great little picture of what the journal looks like. It's looked like this for hundreds of years. Okay? You have your date, because remember, we're going to do everything chronologically. Don't leave off a date, because the auditor can then disallow this. We don't want that. Okay? Well, she put in cash, because it told you. Cash. So cash has gone up $10,000. Now, anytime the owner invests in the company, it's classified as capital. Why? Because again, it is what it is. That's what it says. IRS tells us to do it that way. We're going to do it. So Brenda Clark Capital, $10,000. We have a debit, we have a credit, we balance. Down here, initial investment of cash by owner. Okay. Always an explanation. And we do that for us, and we do it for any auditor that comes in. Okay. And then you can see the cash, the capital, and then make sure they balance. If we do $10,000 on the debit side, we got to do $10,000 on the credit side. Okay. Here, she purchased word processing equipment from Ben Company for $6,000. I haven't seen that word used in a long time, word processing equipment, so we're going to just believe we're in the 1980s. Paying $1,000 and promising to pay the balance within 30 days. Okay? Now, 2 things are going on here. She purchased equipment. Equipment is an asset. Okay? The total is $6,000. So the asset part is going to go up $6,000 under equipment. Okay? She gave him $1,000, so we know cash will go down. Okay? But she still owes them $5,000. The 1,000 minus the 6,000, which she evidently charged. Okay? So here we have word processing equipment is an asset. How do we make an asset go up? We debit. Okay? Cash, $1,000. How do we make cash is an asset? So how do we make an asset go down? We credit. Okay? Now we owe money. So it's an accounts payable. Because at some point down the road, we're going to pay that amount. So the balance is $5,000. Do we balance? Yes. Got $6,000 on one side, $6,000 on the other. Purchase of equipment from Ben Company. Good explanation. If you go back and look at this after 6 months, it'll tell you what you did. Because again, if you're doing hundreds of these a day, you're not going to remember. Okay? This is called a compound journal entry because you have more than 2 accounts that were affected. Okay? Remember, we said it has to be at least 2 accounts, but here you have 3. You have word processing equipment, the asset, cash, another asset, and accounts payable is a liability because you owe someone money. Okay? And then, since it's the next transaction on the journal, okay, let's look. This was the first one. This is the second one. All you need to do is put the first because under all that is May. So you're going to know what the year and the month. Okay? And it makes it faster. Now again, if you're computerized, it does this automatically. You don't have to worry about it. Rented office space, paying $1,200 in advance for the first 3 months. Okay. Now, what's happened here is she's prepaid. And we're going to bring in a fairly new concept to you about prepaid expenses. This is very common. A lot of people that own businesses, if they don't know you and you're kind of new, they're going to make you pay up front. Okay? So, we're going to call this prepaid rent. Now, the IRS says anything you prepay initially is going to be put under prepaid, and prepaid is an asset. Why? Because that's what they want us to do. Okay? So prepaid rent, $1,200 in a debit, because how do you make an asset go up? You debit. And then cash, $1,200, because we spent $1,200. Cash is an asset. How do we make an asset go down? We credit. So, and here's our explanation. Rent paid in advance, 3 months. Okay? May 3rd, purchased office supplies from Norris Company on account for $600. Now, for our purposes, we're going to treat office supplies as an asset. Now, that's very common, especially with really big companies. Okay? I can't imagine how much office supplies General Motors has. So they treat it as an asset because they're spending thousands of dollars a month on office supplies. Okay? So, for our purposes, office supplies is an asset. So, office supplies, $600 because it's an asset. Now, the key word here is on account. That means she charged it. So no cash is transferred hands. So again, this is an accounts payable. We owe that money. She must have went into Staples or wherever and charged it. Okay? So we owe that money, so it's an accounts payable. Purchase of supplies on account from Norris. Okay? And that's the explanation. Completed sales promotion pieces for a client and immediately collected $3,000. Key words here. Promotion pieces, when you hear that, and since she bought a word processor, a computer, this is revenue. This is what she's doing. She's creating things to make money. So she created these promotion pieces. Could be anything. Could be some type of advertising. That's probably what it was. But that's revenue. And that's why you're in business, to make revenue. So, cash, $3,000. Because we collected immediately $3,000, so we know that's cash. The promotion pieces, she's kind of itemized it under word processing fees. Now, anytime you hear the word fees or services, that's revenue. Okay? So here we are. How do we make revenue go up? We credit. Okay? So cash went up. It's an asset, $3,000. Word processing fees, that's revenue. How do we make revenue go up? We credit. Do we balance? Absolutely. Cash received for services rendered. And that's the key. That's why she started the business. Paid office salary, $650. Most of the time, you're going to have people working for you. Office salary is expense. We can expense it to the company. Okay? How do we make an expense go up? We debit $650. And of course, me, you, and the whole world, when we work, we want cash. So how do we make cash go down? Well, it's an asset. We credit. That's how you make an asset go down. Payment of office salaries. Okay. Advertising bill from Al's News Company comes in, but it's not paid. $250. Evidently, Brenda's advertising. And that's what most companies do. One of the trends that are going on right now is advertising on Facebook. It's big, huge. Okay? But she didn't pay it. So maybe they gave her some kind of terms. Net 30 days. Paid in 30 days or paid in 10 days. So we expense it. Advertising expense, $250. Accounts payable, because here we didn't pay it. It tells you not paid. So no cash transferred hands. This is a liability. How do we make a liability go up? We credit. Okay? Bill in, but not paid from Al's News. So probably Brenda said, we don't need to pay that right now. We got 30 days. Let's wait until next month or whenever. Brenda Clark wrote a check on a bank account of the business to pay her home mortgage payment of $625. Now, we have to be careful with these kinds of things, okay? Because since it's her home mortgage, she cannot expense it to the business. That is against the law. And that'll get you audited by the IRS, okay? But there's a simple way to account for it. She's withdrawn money for her own personal use. She owns the company. She can do that. It's her company. So what we're going to do here is Brenda Clark withdrawals. That withdrawal account will be under owner's equity. Okay? For $625. How do we make withdrawals go up? We debit. And of course she needed cash. So cash is an asset. How do we make it go down? We credit $625. Now, do we balance? Yeah. And they're in the right accounts. And our little explanation. Personal withdrawal of cash. Okay? Simple. Now, down the road, at the end of the year, Brenda Clark is going to have to pay taxes on that. Personally, for her. Not the business, for her. Because they're going to call that income. Bill Morris Company for a sophisticated word processing job for $5,000. Now, she billed him. Billed is a key word because we haven't collected any money yet. So now we're going to introduce a new concept called accounts receivable. And this is when people owe you money for services rendered. Okay? So no money has been collected yet, but it will. It will. So we have accounts receivable, $5,000. Accounts receivable is an asset. Why? Because the IRS tells us it is. Okay? So assets, how do we make them go up? We debit $5,000. Okay? Now, she did a sophisticated word processing job, so That's fees or services. We know that's revenue. So word processing fees are revenue. How do we make revenue go up? We credit. So we're going to put a credit of $5,000. We balance. The accounts are right. Then we put Bill Morris Company for fees earned. This Morris Company may be a big company. And she gave them terms. Maybe pay me in 10 days. Okay. Paid office salaries again, $650. It'll be the same post as before. You can see we have office salaries expense, $650. We make expenses go up by debiting. And then cash, because we all want cash, credit of $650. Okay? Because that's how we make an asset go down. We credit. Okay? Paid half the amount owed for word processing equipment purchased May 1st from Ben Company, $2,500. So she bought some of the equipment and now she's paid on the account. Well, we don't owe them the original amount anymore, which I believe was $5,000. So accounts payable goes down $2,500. Accounts payable, of course, is a liability. How do we make a liability go down? We debit. And then, of course, Ben Company is going to want cash. So cash goes down $2,500. Cash is an asset. How do we make an asset go down? We credit. Do we balance? Yes. Right accounts? Yes. And then we put a little explanation. Paid half the amount owed Ben Company. Received and paid telephone bill, $220. Now we can expense that because that's a legitimate expense for a business. You're going to use your phone a lot. Telephone expense, $220. How do we make an expense go up? We debit. And then cash, of course. The telephone companies wants cash. Cash, $220. Cash is an asset. How do we make it go down? We credit. And then our little explanation, paid telephone bill. Okay. So, these were examples of just posting in the journal on a daily basis. These are the things that bookkeepers do on a daily basis. If you're the owner of the company, these are things you need to look at to make sure that the money's going where you need it to go. Now, how do we transfer all this to the ledger? Because remember, the ledger is telling us for each account, cash, accounts receivable, accounts payable, revenues and expenses, and so on, what was done in that account, okay, and the balance. So, it involves the transfer of information from the journal to the ledger. In the debit account in the ledger, record the date and the amount of the entry. So everything you've done, for instance, let's just pick on cash. In cash, for the month of April, say, will be in that ledger. Okay? Everything you've collected in cash, everything you've paid out in cash. Okay? Step 2, record the page number of the general journal in the posting reference column of the debit account. General Journal 1. Why? That's what we call creating an audit trail. So if somebody's looking at the ledger and they want to see the original journal post, they can go to General Journal page 1 and there it is. Okay? Step 3, calculate the new balance of the account. As transactions go on, each account in the ledger, the balances are going to change because that's just how it is. Step 4, record the account number of debit account in the posting reference column of the journal. Okay. Here's a very, very good example of what we're doing. You can see this is the initial investment by Brenda on May 1st. You can see on the journal, again, which is your diary, cash, $10,000, because that's what she invested, and then Brenda Clark Capital. Because she invested it, always goes in the capital account. Anytime you hear the word invest, the credit will be in the capital account. And you see it got credited, little explanation. Okay? Well, that's going to get transferred to the ledger. Okay? And account number 111 was cash. So we're going to take that cash amount and we're going to bring it down, and we're going to put it down here as a debit, because we're going to debit it because that's how we make an asset go up. And then we're going to put the balance. The balance will be $10,000 debit. And then the date. Okay? So let's say halfway through the month, the boss comes in and says, I want to see what we've been doing all month in the cash account. You can pop up this general ledger cash account, and there it is, everything. Okay? The posting reference column tells us which transactions have or have not been posted. Okay? What I see the most if somebody's doing this manually is they don't post from the journal to the ledger. So a lot of times these accounts are not correct. That's why immediately the first thing we say is let us get you computerized, because it will do it automatically. If up here you put the posting reference as a cash account in capital, it will, in a computerized accounting system, it will automatically post it to that account. Okay? In the ledger, the posting reference leads us back to the original transaction. Right there. That will take us back to here. Okay? Because the auditor might want to see it. Okay? Most times when an auditor comes in, they don't necessarily want to see this first, the ledger. They want to see this, the journal. Okay? Users can use the posting references columns to find the journal and ledger transactions. Okay? Now, lastly, we're going to talk about preparing the trial balance. Now, let me preface this by telling you the trial balance is just all of the balances from the ledger by account. Cash, accounts receivable, equipment, so on and so forth. Okay? It's a list of individual accounts with their balances taken from the ledger. Again, if you're computerized, it does this automatically. If the information is incorrectly journalized or posted, the trial balance will not be correct. The trial balance is wonderful because it's a checks and balances. You're checking to see if the number's right and if it's been done correctly. Okay? If the information is incorrectly journalized or posted, the trial balance won't be correct, and it probably won't balance. Then you're going to have to go back and figure out what you did. You can have computational errors, transposition, you meant to put 0, but you put 2, or a slide error, you added 0. Okay, those happen all the time, even on computerized systems. And then just posting errors. You posted it to the wrong account. You meant to post it to electric expense, but you posted it to telephone. Okay? Those are things you find during looking at the trial balance. And here is a classic example of the trial balance from Brenda's business. And they're all the balances from the ledger. You can see here it's got cash, accounts receivable, office supplies, prepaid rent, word processing equipment. Those are all debits because they're assets. Over here you've got accounts payable, $335, Brenda Clark Capital, $10,000. That didn't change because she didn't invest any more money. These are credits because that's how you make those accounts go up. Brenda Clark withdrawals, you have a debit here. She took out $625 to pay her mortgage. Okay, and withdrawals is a debit. Word processing fees, $8,000. That is how much money Brenda made in the month of May. How do we make revenues go up? We credit. So that's going to be a credit balance. Then we have a list of all the expenses. She had office salaries expense. She had advertising expense and then a telephone expense. They're all debits because how do we make expenses go up? We debit. And then both sides, when you add them up, should balance. If it doesn't, you're going to have to go back to the ledger and the journal to see where you made the mistake. Everything we did in here, when we brought it over, we did something wrong. So when we get here, when we get here, it's not the right number. That's why it doesn't balance. Okay? So, and then recompute balances in each ledger account. Okay? You may have to do that like I said, even on a computerized system. And then trace all postings from the journal to the ledger. That's the last resort. You've done all this, you still can't find it. You're just going to have to go back to the ledger and then back to the journal. If you don't find it in the ledger, it'll be somewhere in that journal. Okay? Draw a line through the incorrect entry. Write the correct information above the line and write your initials near the change. Now, if you're on a manual system, do not erase it. Do not white it out. Anything like that. Because that is a big audit error. Okay? Just put a line through it and write the correct amount on top. Okay? And then balance it. Okay? You can see here a great example. They put it in accounts receivable, but it's not where it went. They meant to put it in accounts payable. They found that out when they looked at the trial balance. And then whoever this is put their initials. And it would not be a bad thing to do. Put your initials and the date. Okay. And here, well, looks like we transposed some numbers under accounts payable. We meant to put 250, but we put 520. These are common errors. Happens all the time. Okay. Draw a line through the error and write the correct figure above it. Change the running balance to reflect the corrected posting by drawing a line through the balance. The corrected balance is written above it. If you're computerized, it does this automatically when you change it, and it will even keep a record that you went in and corrected it. Okay? And there you go. There's a wonderful example of them in the ledger fixing what we just talked about. So a correction must first be made to the journal and include an explanation. That's where you make the correction first, the journal. The correct information must be posted to the appropriate ledger account. So if on the journal you have to adjust cash, when you go to the ledger, go to the cash account and adjust that too. Again, if you're computerized, it will, once you make the adjustment on the journal, it'll automatically post the correct one to the ledger. Okay? The journal entry is corrected and explained. Okay? And there you go. The advertising expense ledger account is corrected, so we have the right amounts. And we want to make sure we have the right amounts, because all of this information, we make business decisions based on this. So we want to make sure it's absolutely correct. Okay? And then the telephone expense ledger is corrected. Okay? And that's it. I hope you enjoyed it, and I hope it helps you, and have a wonderful day.